My name is Michael Konczal. Thank you for joining me. I'm going to tell you a story. We're going to get the slides up in a second. I'm going to tell you a story about a bank run. We're going to have an image in a second. Most of you have seen It's a Wonderful Life. And one thing that I started finding out when I started investigating bank runs is that there's this whole genre of late 19th century plays, these Broadway plays where there were bank dramas, or dramas about bank runs. And it's very odd, looking at the 20th century, post-New Deal, how much we were able to solve that problem through strict rules, through prudential regulation, and through having very systematic sense of what regulators need to be doing. So there we go. So I want to walk you through three models of how banks work. There's been a blurring of these business lines over the past 30 years, and we're going to talk about that and how it's related to where we are today. So this is your George Bailey Bank. This is the original commercial bank. Many of you have savings accounts, checking accounts, maybe in a small community bank. They take funding in through your deposits, and they lend out relatively illiquid consumer and commercial loans. Okay? They have a problem because there's a mismatch in liquidity there. And I want you to keep focused on the liquidity issue. You could take out your deposits pretty quickly, and they can't sell assets fast enough without causing a fire sale. If they cause a fire sale, more people will want to take out their deposits. They don't trust the bank. That requires them to sell more assets, and it spins. So around 1934, we came up with some good rules for how to handle that. We insure deposits, so people feel safer leaving them in for longer periods of time. There's the ability for commercial banks to borrow from the Federal Reserve to handle that liquidity. They're the lender of last resorts. And that has worked very well for us. Now there's another model, investment banking. This takes funding in through the capital markets. It's very efficient. It's very fast. It's low cost. However, the liquidity is very high. Oftentimes, these loans are for a day at a time. Repo markets, there's many other places that they borrow from. Their assets also are very liquid. So the liquidity match is there as well. And then we have a third model, proprietary trading, things like hedge funds, where there's a variety of strategies, and they have different options for their liquidity, for funding, to match what their assets are. Now, what I want to argue is that over the past, OK, that did not convert very well, we've had a merger of the three banking models. We've had a bunch of new types of businesses that have shown up post-1980 deregulation. Okay? Now, the thought of thinking of the overlap of these business models has been on the mind of many regulators and commentators over the past month, which is something called the Volcker Rule. The idea that we should split proprietary trading from commercial banking. So that's, do we get this here? So that's over here. I want to argue to you, that's not a bad idea, but I want to argue to you that the real problem of this crisis is over here. It's in the overlap between investment banking and commercial banking. It's with those institutions, many of them Bear and Lehman you probably know about now. It has a specific problem because it's using short-term funding of the investment banks to lend long into illiquid commercial and consumer loans. It takes capital market funding in, funding that's often overnight, even more prone to panic than your deposits, and it uses it to fund commercial and consumer loans. Things that are illiquid, things that are hard to sell without triggering fire sales. So what does that look like? Let's walk you through this. So you want to start a shadow bank, so you go to the repo markets, the money market funds, and get funding. Use a short-term debt. I'm going to talk about SIVs. There's a lot of different mechanisms that were used for this, but SIV is one. There aren't many left, if any. You keep it off the balance sheet, so you don't have to worry about it. That gives funds for asset-backed securities, which you then use for collateral. Okay? Now, the repo markets can take their money out at any time, but they can also charge you a haircut. And if the haircut goes up, it's the equivalent of trying to get your money out. They are essentially giving you less leverage. Okay? The asset-backed security comes from consumer debt. And in order to handle the credit risk of these asset-backed securities, they relied on the ratings agencies for analysis, and they used the over-the-counter CDS market for insurance. One of the reasons they could use the over-the-counter CDS market for insurance is because the ratings agencies were also involved with setting the collateral of those places like AIG Financial Products. Okay? So to remind you, so what we saw is that we had asset-backed securities. A lot of them had subprime in them. It wasn't a very transparent market. So when worry started to come, repo markets got nervous. They wanted their money out. That required them to sell off asset-backed securities. Suddenly people were worried about whether or not this insurance with the CDS market at the monolines and AIG Financial Products was really there. That made the funders more worried. More people showed up at the banks to get their deposits out. That required a fire sale. Suddenly we have another loop here. Okay? So this is what a bank run looks, in the 1930s. This is what it looks like now. I told you earlier a little bit about repo haircuts. This is what a bank run looks like in the 21st century. Okay? Starting in fall of 2007 and skyrocketing in fall of 2008, depositors wanted their money back from these shadow banks. Okay? So this has been a long development in the financial markets. It's been happening for about 30 years. And we can tell that people knew about it because the share of commercial loans held by commercial banks was declining significantly as this period went on. As the shadow banks took on more of the investment-grade commercial market, as they took on more prime loans, as they took on more prime debt through credit cards and monolines, the commercial banks were forced more to concentrate in the riskier parts of the commercial lending. They were more focused in small business loans. They were more focused in that area. So the regulators in 1999 had two choices. They could either try to make commercial banks more competitive with shadow banks, or they could make shadow banks regulated like regular banks. They chose to go with the Graham-Leachy-Biley Act. Now, they had three assumptions. Let's avoid whether or not they passed this in order to try to allow a merger to go through. We'll stay away from Rick Carnell's world of regulation. This is the most idealistic argument for this. And their argument would be that commercial banks could compete successfully with the shadow banks. That turned out to be false. Commercial banks were not, with few exceptions, notably Citigroup, which lobbied very hard, commercial banks were no more successful from having access to the capital markets. The second one is that the shadow banks had a better business model because they were deregulated. They were making so much money because they're smarter than the commercial banks. We'll see why in a second, but that's not true. And the third is that even if it's not a better business model and it fails, taxpayers are not on the line. Okay? So those new kind of businesses we talked about in the overlaps, the shadow banks, let's take a look at how they did. Let's chart them against four different types of bailouts: charter change, capital infusion, debt guarantee, and asset guarantees. Those are all the overlapping business I talked about earlier. Here's how they stacked up with bailouts. Obviously, there was a major failure here. So how to fix this? Well, one thing is we can fix the parts that are broken here. You're hearing these presentations one at a time, siloed, but it's important to see how the architecture here has each one of them make each other stronger. Okay? So if we can reform asset-backed securities, if we can reform the securitization process so it is more transparent and has better information, we are less reliant on the ratings agencies. If we can stop the complexity machine of consumer debt, it is easier to put them on your balance sheet, securitized consumer debt. You have a better sense of what it's worth. You can capitalize against it better. Okay? Good regulation begets better regulation. Good information and good transparency in one part of the diagram feeds into every other part. And the opposite is true. Bad regulation causes each other part to be weaker. So if derivatives isn't reformed, suddenly we have this extra level of a lack of transparency funneling into the balance sheet, funneling into the securities market, securitization market. Okay, so that's one thing to start with. The second thing is there's a regulatory arbitrage here. There's a way for a bank to be a bank without having to follow the rules of being a bank. So the way to combat that is to force them to be banks. So anyone who is involved in this sector needs to be regulated like a commercial bank. There are simple rules, holding capital. The other thing is that they have a funding arbitrage, that they are actually, one of the reasons they're more profitable is they're taking on all this liquidity risk. So the way to combat that is to force them to hold capital against liquidity and stress test in the sense of liquidity. We talk a little bit more about this in the book. And the last thing is we need to make sure that we are not de facto expanding the scope of guarantees. We are not saying that no matter what happens with the shadow bank, we will always bail you out. So we need some sort of FDIC-like mechanism for resolving a shadow bank. And I think with these kind of reforms in mind, it's possible to stop this from happening again. Thank you.